Welcome to another episode of Quest for Twice. Today is October 25th. The earnings season has started. Today I'm going to cover earning updates from several companies. The first one is Kinder Morgan. So Kinder Morgan provided the update. The full year EBITDA will likely slightly below the initial budget of $8.2 billion. Net debt had a small reduction to $31.7 billion. The stock price has risen a lot since first quarter of this year. Now, the market cap is about $55 billion. And the full year DCF will likely be slightly below initial budget of $5 billion. So there hasn't been much update to its business prospect, but the stock price increase had made the valuation levels more expensive. Now EV over EBITDA is 10.6, and the forward dividend is about 4.6%, only half a percentage point higher than the 10-year treasury yield. So the market is pricing in a lot of growth due to the power demand from AI compute, which may not realize. The next one is Equifax. And shown in the figure at the bottom right, the USIS segment grew 12%, with the mortgage related revenue grew by 36% from 1 year ago, but it's roughly flat from second quarter and first quarter of this year. EWS was up 7% from 1 year ago with 4% mortgage growth. So it's also a similar level of revenue from first and second quarters of this year. International revenue was up 18% driven by M&A. Overall, sequentially comparing to second quarter, Equifax's revenue is almost flat. EBITDA margin was down slightly from 1 year ago, driven by $20 million of a higher corporate cost. A piece of good news is both EWS and the USIS cloud transformation have been completed. So most of the cloud transformation is done. Let's look at the growth drivers. As I just mentioned, the single data fabric with high reliability in the cloud will be a revenue driver down the road, because it facilitates new products and innovations, as shown in the vitality index in the middle on the right. So third quarter had about the same vitality index as the second quarter, which average out will likely be slightly less than 2023 and similar as 2022. The workforce solution segment will likely continue to be a growth driver, with 9% non-mortgage growth in the third quarter. The management mentioned last year, after the BV acquisition, that the company will pause with the major acquisitions to reduce debt. But in the last 3 years, M&A added $610 million of run rate revenue. So overall, fairly plain third quarter update. Not many highlights, but nothing really to punish the stock with either. with the interest rate reduction, in theory, there will be more demand for credit and more demand for Equifax products, but we haven't seen that translated into revenue growth. The last one is Tesla. In the figure on the top right, we can see revenue grew very quickly since 2017, and then plateaued in 2023, and in this year, it's about the same amount of revenue as in 2023. For gross margin, before the pandemic, the margin was a little less than 20%, but rose to above 25% in 2021 and 2022, with a dip in 2023 and 2024 back to pre-pandemic level. So with that context, let's look at the quarterly results as shown in the bottom right. We can see the revenue grew quickly since first quarter 2021, then peaked in fourth quarter 2022. Then it just basically plateaued with some fluctuations in the last 2 years. On the margin front, as I mentioned earlier, the gross margin peaked at the end of 2021 and the first quarter 2022. That's due to the shortage of auto parts and new automobiles during the pandemic. Then it moderated to 25% in the most of 2022 before drifted below 20% in the last 2 years. However, in third quarter of this year, the gross margin rose from a low level of 18%. That's partly due to the higher regulatory credits the company received in the third quarter and second quarter of this year. There also could be some effects due to the geographic mix of Tesla products in Asia versus outside Asia. Nevertheless, because of the gross margin improvement and Tesla's effort to hold the operating expense low, then the operating margin jumped to almost 10% from just over 6% in second quarter. The question is, will that trend continue? I suspect it will not unless Tesla can reignite revenue growth. Now let's look at the valuations and risks. The figure on this slide shows the gross profit growth in percentages from the same period 12 months ago. So we can see Tesla's gross profit has been growing in waves, with a wave in 2013, 2014, then 2016 and 2017, and then 2019 and during the pandemic. Those growth waves were corresponding to the model releases of Model S, Model X, Model 3, and Model Y. It's interesting to note that before the pandemic, the troughs of gross profit growth have been brief, but now the negative profit growth has lasted almost a year, much longer than the previous troughs. Now let's look at the valuation levels. I use EV over gross profit as a valuation metric. So currently at the $260 per share, that ratio is about 45, which is a rare occurrence before the pandemic. During the pandemic, that metric reached about 100, then plateaued for about 2 years above 70. So current valuation level is above historical average. Also, interestingly, in the past, the valuation level did not change dramatically with the waves of gross profit growth. That changed in 2020 when the Model Y was released. Given that Tesla will unlikely be releasing a cheap model nicknamed Model 2 in the near future, then the current valuation level is really based on potential values from autonomous driving and domestic robots. There are some key risks to this valuation. The first one is regulatory. So, what are those regulatory hurdles to deploy a level 4 fully autonomous driving? Also, Tesla use cameras plus AI to support autonomous driving. So, can that really deliver to a very high reliability? Because the consequence of being wrong will be a major accident may involving fatalities. It's interesting to note that all the other manufacturers rely on LiDAR as an additional tool for autonomous driving, but Tesla does not use it because of a cost concern. This concludes this episode of Quest for Twice. Until next time, happy investing.